In the preceding lecture, we have discussed how to reorganize financial accounting information to make it ready for company valuation. At the upcoming lecture, we are going to look into how to benefit from these reorganized accounting to compute some financial ratios that are going to be useful for analyzing the company's historical profitability. We can say that financial ratios are useful tools that allow us to see things in perspective and to make appropriate comparisons. Every financial ratio has two components. The lower part, the denominator, represents the resources invested in the company by the capital providers, by the owners and the creditors. These resources are then productively employed in the company's operation to generate some output. And the magnitude of the output will be recorded in the numerator in the upper part of the ratio. So in other words, we can say that a financial ratio tells us how much output was generated for the unit of resources invested in the company. For example, let's have a look at ROE, the return on equity. It is defined as a ratio of net income and equity. The ratio tells us how much profit the company earned for the owners who provided equity. You may ask why we want to analyze financial ratios rather than raw accounting numbers. The reason is that any reasonable analysis requires comparison. We want to compare the company with its peers to see how well it is doing relative to its closest competitors. We also want to compare the company's historical performance over time to see if there has been an improvement or a decline in performance. Such analysis is very difficult to do without financial ratios. Companies differ in size, and therefore some companies may generate more profit just because they are larger rather than that they are being more profitable. And therefore it is important to use financial ratios to put all companies on equal footing and to measure how much profit they produce per unit of capital that they employ. In a similar way, financial analysis using financial ratios will be important for the time series comparisons. Companies grow over time, and sometimes this growth may be discontinuous as a consequence of a large merger or an acquisition. In such case, it is very obvious that a company increases the amount of profit it generates just because it has become larger. It is therefore important to convert the profit generated per unit capital of the size of the company at that point in time to make the numbers comparable over time. Expressing profitability as a rate or a percentage also allows us to decompose it to the individual components or drivers. For example, consider the leverage formula. It decomposes total profitability, ROE, into its operating and financing parts. Now, all four components in this equation are expressed as a percentage. ROE, ROIC, financial leverage, and spreads are all percentages. And therefore, it is possible to place them in one equation. In other words, these percentages allow us to analyze how the operating part and the financing part of the business contributes to the total profitability. Financial leverage constitutes an essential concept in investing. The leverage formula that uses financial leverage as one of its components captures a fundamental association in profitability in companies. And that is why my first question this week will be related to this concept. In answering the first question, I want you to first discuss what leverage actually is. Then discuss what implications having higher leverage has on the company's overall profitability. There will be some benefits and some drawbacks, and I want you to discuss both. After that, I want you to look at the etymology of that word. You probably remember the concept of lever from secondary school physics, and you will see that it is no accident that financial leverage uses the language of physics to express this concept. So I want you to explain what lever is in physics and how the lever in physics is related to financial leverage in economics. And finally, I want you to discuss how financial leverage is related to the cost of capital of the company. And here I presume you can get some inspiration from what you learned in the course of corporate finance. As usually, the first and the second questions are variations on the same theme. In the second question, I want you to choose from the offered alternatives the statement that best characterizes the connection between financial leverage, company's profitability, and the cost of capital. I will refer to the leverage formula as the first level of profitability decomposition. Viewed from this perspective, the DuPont formula represents the second decomposition level. It decomposes the operating profitability measured by the return on invested capital, ROIC, into two components: the operating profit margin and the net operating asset turnover. You will later see that the profit margin and the asset turnover will be rather essential for us in forecasting free cash flows. It is therefore important to understand how they are related to the total company's profitability. So the third question this week will be related to the profit margin and asset turnover. First, I want you to discuss what the two actually measure, what they represent. Then I want you to look into what economic forces determine profit margin and asset turnover. Please explain which companies you expect to have high or low profit margin and which companies should have high or low turnovers. You can also discuss which forces will push the profit margin upwards and which forces will depress it. And the same can be done for the asset turnover. Finally, after having discussed these two questions, I want you to explain how these two measures are correlated. In other words, do you expect companies with high profit margin to also have high asset turnover, or do you expect an opposite relationship? Finally, I will ask you to use your conceptual understanding of the profit margin and asset turnover in an applied case. I will show you a figure from a research study with information on the profit margin and asset turnover in individual US industries. I will ask you to read the figure for me and to determine which industry is which. In addition to that, I will want you to discuss which of the two industries has higher operating profitability. This is the figure I want you to consider when answering question 4. It shows the operating profit margin on the vertical axis and the asset turnover on the horizontal axis. The dots in the graph represent median values for individual industries. I have selected two industries, A and B. I tell you that one of them is retail and the other one is oil and gas. Please read the graph and distinguish between the two industries. In addition, based on the information provided in the graph, tell me which of the two industries has higher operating profitability. Finally, I want you to use your conceptual understanding of the concept of the profit margin and asset turnover in an applied case. I will show you a figure that provides profit margin and asset turnover data for several industries. I will pick two specific industries, that is to say general retail, companies like Walmart, and oil and gas, that is to say companies like ExxonMobil. I want you to use your understanding of the drivers of the profit margin and asset turnover to determine which industry is which and what you can say about their overall profitability. This cartoon nicely demonstrates that even though financial ratios are very useful tools that can help us understand what is going on in the company, one can overdo it even with financial ratios. However, I hope that you will use financial ratios efficiently and they will help you analyze the historical performance of the companies you will value.